Okay, we're going to revisit some of the concepts around cost of capital. We're going to dive in a little bit deeper here than we have in the past, although, again, concepts are going to be consistent and we've been building on these right along. So while this is a relatively long chapter, it should be pretty straightforward. Cost of capital represents a firm's average cost of funds, which is the average return required by that firm's investors. It's the amount that really needs to be paid to attract funds, and it's the return that must be earned on invested funds to cover the cost of using the funds. And we've seen this concept throughout the course so far, and the firm's required rate of return is generally shown as the variable R. Investors who are participants in financial markets determine a firm's cost of funds. It's driven by supply and demand. We talked about this early when we were discussing some of the rates of returns associated with bonds. So as demand for a specific asset increases, the required rate of return goes down and vice versa. The firm's cost of funds change when conditions in financial markets change, when investors' general risk aversion changes, whether that investor is more or less averse to risk, and whether the firm's general risk changes. So market risk, investors' appetite for risk, or the firm's risk itself. There are a few elements that we look at from a capital perspective on how the capital stack is built in a firm. And so the elements that go into each of these components are the before tax interest cost, which is the cost of the debt, which is the R sub D, the after tax cost of debt, R sub DT, because interest is tax deductible. And so while dividend payments aren't tax deductible, interest is tax deductible, so there's an attraction for firms to use debt as opposed to equity. Cost of preferred stock, return on preferred stock, return on S, retained earnings, and return on E, which is external equity. Essentially, the cost of going out to market to get additional primary equity or get additional equity in from investors that aren't in trading in the stock. The weighted average cost of capital for a firm is the average cost of each $1 the fund uses. And a capital structure or capital stack is the combination of the different types of capital, debt and equity, used by a firm. The capital structure impacts the weighted average cost of capital, which then impacts the overall return on required rate of return for the firm. So the cost of debt, we talked a little bit about debt generally. The cost of debt is focused on a couple elements. First, the bondholder's required rate of return, as well as the tax rate or tax savings. So relevant cost of new debt includes tax deductibility of interest and the yield to maturity based upon the bond's position in the capital stack. So is it secured, unsecured? Is it senior or junior? And what the duration of that bond is. And I won't get into bond duration. That's a specific investment term. But essentially how long that bond is going to be outstanding for and how sensitive it is to interest rates. That's going to determine the bondholder's required rate of return. And once we've determined the bondholder's required rate of return, because that amount is deductible if it's interest, then you've got a tax savings associated with that. So the after-tax cost of debt is driven by not only the bondholder's required rate of return, but also the tax savings associated with that bond for the corporation. So let's take a look at an example. A firm that currently has debt with the following characteristics wants to issue new debt to raise funds to support its future growth. So it wants to issue debt with a $1,000 maturity value, a coupon rate at 9% paid semi-annually, with a 12-year outstanding. The current market price for that bond is $931 and the marginal tax rate is 40%. Based on the preceding information, we know that the following relationship exists. The value of the bond today is $931. That's equal to 45, 45, 45, 45, all the way out for 24 periods. Plus you get the $1,000 back at the final period. You put that over the required rate of return for debt, and that's going to give you the required yield or the actual yield to maturity on that bond. Now, the actual yield to maturity on this bond is going to be greater than 9%. We know that because it's 9% coupon on $1,000, but the bond is currently trading at a discount. So it's currently priced less than $1,000, which means there's a higher required rate of return on that bond today than 9% because that's what it's paying, but you're not getting that full $1,000 price. And so the yield to maturity on this bond we know is going to be greater than 9%. Because interest is paid every 6 months, the computation of before tax cost of debt is based upon semi-annual compounding. Thus, R sub D divided by 2 is the 6-month rate of return. The annual rate is 10% yield to maturity. If the firm's marginal tax rate is 40%, 10% times 1 minus the tax rate equals 6%. So the after-tax cost of capital for debt is 6%. The yield to maturity from the investor's perspective is 10%. The cost of equity is based upon a required rate of return by the firm's stockholders. So the cost of preferred stock is the dividends received by the preferred stockholders. It represents an annuity, and there's going to be an imputed rate of return associated with that. There's a cost of retained earnings, which is the return that common stockholders require for the firm to earn on the funds that have been retained and reinvested in the firm rather than paid out as dividends. And then there's cost of external equity, which is a rate of return required by common stockholders, including flotation costs if they're going to go out and get new money invested in the firm. The rate of return required on preferred stock is going to be, the required rate of return on preferred stock is the dividend paid on the preferred stock over the net price of the preferred stock. The net price of the preferred stock is the price of period 0 minus flotation costs. And flotation costs are the amount that you would end up having to pay an investment banker, and we talked about them early in the course, an investment banker to actually go through the process of registering and selling these assets. The company doesn't get that back, so there's a net price to the firm, which is the price that the original person paid plus a flotation cost. So in this particular case, the firm has preferred stock with the following characteristics. It's got a market price of $120. The dividend it's going to pay is $12.80. That gives it and there's a flotation cost of 3%. So in order to calculate what the required rate of return on preferred stock is, or what the return on preferred stock is, it's $12.80, which is the dividend paid. The amount that's actually going to the firm, which is $120 market price minus a flotation cost, $116.40. We divide $12.80 by $116.40 and we get 11%. There is no tax adjustment on preferred stock because payment of preferred dividends isn't tax deductible. While payment on debt is tax deductible, payment on preferred stock is not because it's a dividend. For the cost of retained earnings, a firm must earn a return on reinvested earnings that's sufficient to satisfy common stockholders' investment demands. Otherwise, the common stockholders will sell the stock and buy something else. And if the firm doesn't earn a sufficient return on earnings it retains, they should pay them out as dividends, and again, give an opportunity for the existing investors to reinvest those dollars as something that's going to provide them with a rate of return that's equal to required. here's a basic standard formula. Assuming the stock market is at or near equilibrium, we know the following relationship exists, which is that the required rate of return on the stock is equal to the risk-free rate plus a risk premium for the stock, which again goes back to the capital asset pricing model. And that equals the dividend expected rate of return, which is a dividend expected to be paid at the end of period one over the price today plus the growth rate. And that'll equal the expected rate of return on the stock, R hat sub S. Again, going back to cost of retained earnings, there's the CAPM approach. We've hit on this numerous times. Same concept over and over and over again. Required rate of return on any financial asset, but again, we'll go with the stock here, is a risk-free rate. So you can see that you've got the risk-free rate plus the risk premium on the stock. Risk premium on the stock is risk premium on the market times the beta of the stock. The risk-free rate plus the risk premium of the market is the required rate of return on the market itself times the beta of the stock, which is the volatility associated essentially with that stock as it relates to the market. In this example, suppose the risk-free rate is 6%. The market rate is 10.5% and beta is 1.6. What's the required rate of return on the stock? Well, the required rate of return on the stock is 6%, the risk-free rate, plus the market risk premium, which in this case is 4.5% times 1.6. That gets you, again, order of operations 4.5 times 1.6 plus 6 gets you 13.2%. And this assumes that the stockholders are well diversified so that this stock represents part of their portfolio, not their entire portfolio. Remember, you do not get compensated for the value associated with taking firm-specific risk, only well-diversified risk. The cost of retained earnings on a discounted cash flow approach is the same calculation when the stock market is in equilibrium, and that's going to be the dividend yield plus the expected capital gain on the asset. So in this particular case, you've got a dividend that's being paid out, which is growing at a constant rate of 7.5%, is expected to pay a dividend equal to $1.28 at the end of the year, D hat sub 1, and and the stock currently sells for 22. So if we go back to the formula, you've got the expected dividend over the current price plus the growth rate. So this reduces to 5.8%. That's the current expected yield on that stock for dividends, plus a 7.5% constant growth rate. Add those two together, that gives you 13.3%, which is the required rate of return on the stock. Cost of retained earnings. The other one is to look at a bond yield plus premium approach. Studies have shown that the return on equity for a particular firm is about 3 to 5 percentage points higher than the cost of debt. And so if you want to estimate what the return requirements are for the equity, you can take the current cost of debt, add 3 to 5%, and get to an estimate for the required return on stock. And this is sometimes useful when you don't have publicly traded equity, when you have a privately held company, but you do have either publicly traded debt or there's bank debt that you can analyze. So the required rate of return on the stock is equal to required rate of return on the debt plus 4%. So if the required rate of return on the stock or on the debt is 10%, you add 4% to it, and the required rate of return utilizing the bond yield plus premium approach would be 14% in this case. Oftentimes, you'll use multiple methods and triangulate them in order to be able to give you a best estimate for cost of retained earnings. You'll see the three approaches use different assumptions, and sometimes it's best to look at all three of them and determine what the outcomes are. And if there's a significant difference, you might want to dig into them a little bit more. So CAPM approach assumes investors are well diversified. Discounted cash flow assume the firms grow at a constant rate, and a bond yield plus risk premium approach assumes that the return on equity is related to the return on debt. So ideally, all three give the same result. If not, you may want to use an average of the three, and that might give you a little bit better picture of what the required return on. The cost of newly issued common stock for external equity. Similar to preferred stock, you're going to be looking at dividends and flotation costs, but you also have the growth rate because it's expected that the firm will grow over time. So the rate of return required by common stockholders after considering the costs associated with issuing new stock, the flotation cost is R sub E. That's going to equal the expected dividend at the end of period 1 over the current price minus or times 1 minus the flotation cost plus G. So it's the net price plus G. That's just like what we saw for preferred stock. And a flotation cost is stated as a decimal. So the cost of new equity is greater than the cost of retained earnings because a firm must pay flotation costs to issue new stock. You don't get to do it for free. You have SEC filings, you have investment bankers involved. They all need to get paid. You've got lawyers involved, so there's flotation costs anytime you issue a new security. So let's take a look at an example. A firm which is growing at a constant rate of 7.5% is expected to pay a dividend equal to $1.28 at the end of the year. Its stock currently sells for $22. When it issues new common stock, the firm pays its investment banker 17% of the issue. It's pretty high, by the way. So what does that look like? Well, you've got an expected dividend at $1.28, current price at $22, and there's a 17% flotation cost, and the company is expected to grow at 7.5%. And so the required rate of return on newly issued common stock is 14.5%. This goes to 7% here plus 7.5%, which is a constant growth rate. You've got a optimal capital structure. So one of the things that as a finance professional you're expected to do when working for an organization is to look at the current capital structure and the optimal capital structure and make sure that when you need to raise money or you're going to pay back money, that you have a target capital structure that's optimized. And the optimal capital structure is what's the percentage of debt, preferred stock, common equity in a capital structure, capital stack that maximizes the price of the firm's stock. Because again, if you go back to the top of the course, if your primary responsibility is to maximize value to the shareholders, your job at that point is to maximize the value of the common stock. The weighted average cost of capital is how we start to analyze this, and it's essentially we combine the various costs of capital, debt, preferred stock, common stock into a single required rate of return based upon their weighting within the capital stack. And we use each proportion, add up the weighted average and come up with a weighted average cost of capital for the firm. And you can see that formulaically here, weighted average cost of capital is the weighting of the debt times the required return on the debt plus a weighting of preferred stock times the required return on preferred stock plus a weighting of stock times the return on the stock or the return on newly issued equity. Here's an example we'll walk through. If you have debt and it's 45% and the after-tax cost is 6% on the debt, preferred stock, you've got 5% in your capital stack and the after-tax cost is 11%. And common equity, you've got 50% of your capital stack is common equity, and it's 13.5% for existing retained earnings and 14.5% because of flotation costs for new stock. If the firm can use retained earnings to finance new projects, the weighted average cost of capital is 0.45 times the 6% for debt, plus this amount for preferred stock, plus this amount for the common retained earnings. So your weighted average cost of capital is 10%. If the firm's got to issue new common stock to finance new projects, you have to use, instead of the 13.5% for retained earnings, you have to use the 14.5% that we calculated for new equity issue, which gets you a 10.5% weighted average cost of capital. there's a logic behind using weighted average cost of capital, and that is that there's trade-offs between utilizing debt, equity, and preferred stock. Debt gets paid back first, but it also, the more debt you have, just like with a person, your credit score starts to go down. So the more debt you have, the more risky the firm is. And so that begins to impact the required rate of return to equity or to preferred stock, anything below that debt on the capital stack. So the use of debt impacts the ability to use equity and vice versa. So weighted average cost of capital should be used to evaluate projects regardless of the specific type of financing used to fund that particular project. So you may go out and say, well, I'm going to buy a new truck, so I can borrow that entire amount at 0% interest, from whomever for 5 years, and so therefore my cost of capital is zero. Really, your cost of capital is what's the weighted average cost of capital after you're done, and what does that look like, and how did that impact your required rate of return on stock, and how did that impact your required rate of return on raising new equity if you need to raise new equity in the future. The marginal cost of capital is the weighted average cost of raising additional funds, and the marginal cost of capital is also generally greater than the existing weighted average cost of capital because the firm's risk increases as more funds are raised. You have dilution of the common stock, plus you have, if you're looking at debt, you have additional debt on the books, and you may have additional debt above you in the capital stack, even if you're a current debt holder. And then each time you issue additional securities, you've got these flotation costs or issuing costs that need to be paid to investment bankers, attorneys, SEC, etc. And so there's what would be called an MCC schedule or marginal cost of capital schedule, which is a graph that shows the average cost of funds at various levels of new financing based upon the debt, the equity, and the flotation costs. So let's take a look. We've got a MCC schedule for Unilate Textiles, which you recall from a few chapters ago. We did an analysis and recognized that they were a little bit challenged. And we took a look at the current weighted average cost of capital up to this point. They've got retained earnings of $30.5 million. So they're sitting at a weighted average cost of capital at 10. Once they have to start raising new capital, the weighted average cost of capital goes up because you have flotation cost to 10.5. A break point occurs when weighted average cost of capital increases, which is caused by an increase in any component cost of capital, whether that's required rate of return on debt, whether that's the beta, whether that's the flotation cost. Cost of funds increase as a firm uses significantly higher amounts of capital because risk increases, particularly debt capital. And here's a quick calculation of breakpoint. It's equal to the maximum amount of lower cost of capital of a given type and a proportion of that type of capital in a capital structure. So you end up with a breakpoint, at which point the cost of utilizing that lower cost of capital, normally that's going to be debt, triggers a change in the required rate of return. So here's the example. Company Unilate. Company plans to generate $30.5 million in retained earnings this year. The firm can borrow in the following increments. You've got debt from 1 to 54 million. The before tax cost is 10%, and above 54 million, the before tax cost is 11.85%. And that's driven by essentially the generation of retained earnings and the amount of debt. 2 breakpoints exist for Unilate. After $30.5 million of retained earnings is exhausted, new common stock must be issued to raise additional funds. And if the firm needs to issue more than $54 million of debt, the cost of debt increases. So the breakpoint associated with retained earnings, if we've got 50% of our capital stack is in retained earnings and we're going to have $30.5 million worth of additional retained earnings this year, that gives a breakpoint at 61 million, because essentially at $61 million, you're going to have to go to past retained earnings to issue new stock, which is going to incur flotation costs. On the debt side, it's 54 million at a 45% capital stack, so it's 120 million in total funds that you can raise. Once you get debt above 54 million, your interest rate rises. So here's an example. The break points for retained earning is 61 million in total new money raised, and the break point of debt is 120 million. Again, we're trying to keep all things constant as far as the weight of the capital stack. So what that would look like at 61 million is you'd raise 30.5 million of additional common equity, which is the amount of the retained earnings. That would be at an after-tax cost of 13.5%, and that comprises 50% of the capital stack. Preferred stock, if you were going to raise 61 million and you were building off that 30.5 million of retained earnings, you should be able to maintain your current capital stack percentages. You would raise an additional 3 million of preferred stock at 11, and it would raise an additional $27,450,000 of debt because it comprises 45% of your capital stack at 6 after tax. So the weighted average cost of capital just multiplies the weight times the after-tax cost, which gets you a 10% weighted average cost of capital. And again, you can see how the debt works down here based upon what we built up earlier. However, if we're going to try and really blow this thing out a little bit and want to raise $120 million, you've got the debt at, let's say we want to raise $120 million. We've got a break point at 61. We've got the break point for 120. So if we're going to raise from $61 million and $1 to $120 million, you would need to raise additional common equity beyond what was retained and what was retained earnings. And so the required rate of return here changes to 14.5%. So your weighted average cost of capital, again, debt doesn't change, preferred stock doesn't change, and common equity increases from 13.5 to 14.5 associated with the need to raise additional equity and the flotation costs. So now your weighted average cost of capital goes up to 10.5%. If we wanted to raise even more money, let's say we want to raise $130 million, you would have your debt increases to 11.85%. That was given. Your after-tax is reduced, so it's multiplied by 1 minus the tax rate. So your after-tax cost of debt is 7.1. And you would do that same weighting. You're assuming everything stays the same as far as the weighting being optimized. So the common equity now is 65 million to be able to keep it at the 50% percentage of capital stack, which means you're still in this 14.5%. So now your weighted average cost of capital has gone up to 11%. What you're going to do is utilize the marginal cost of capital schedule to find your specific cost of capital for determining a project's net present value, and you'll develop an investment opportunity schedule. Essentially, that's a graph of the firm's investment opportunities ranked in order of project's internal rate of return and what the total cost of raising those dollars are. So if we've got new capital raised during the course of the year, up to the first break point, your WACC is, and you can call it a WACC, weighted average cost of capital is 10%. Your WACC here is 10.5%. Your WACC here is at 11%. Your 120 break point, your $61 million break point. So you plot that out, and then you go, okay, let's start crossing that against the projects that we've got available. So we combine Unilite's marginal cost of capital investment opportunity schedule. So what we've done now is let's think about what we just did in Chapter 10. You've got projects. Well, normally companies have a ton of projects. So you add up all the projects that are available to you. And you say, okay, here's all the projects that are going to be available to me. I'm going to stack rank these projects based upon my initial cost and the amount of cash flow that it's going to bring in, the life, and then the internal rate of return associated with each one of those cash flows. And then I'm going to plot them on a graph against that weighted average cost of capital and see what projects I want to do. Now, ideally, and again, with a couple caveats around time value money, you're going to start with, I want to make sure I get my highest value project with the highest IRR done first. So I would want to do this. I would want to do this project first, then this project, then this project, then this project, then this project, because this one gives me my highest rate of return. This one gives me my lowest. All of them are above 10%, however, which was my initial weighted average cost of capital, assuming these are of normal risk. So how would this look? Well, I know I've got to raise additional money in order to be able to get these started. So we start plotting that against the chart that we just had. So you had our weighted average cost of capital with a breakpoint at 61 and a breakpoint at 120. Then we say, okay, for that 12.1%, that required about $40 million. Then we had the 11.7, that required an additional 20-some million. Then we had the 11.5, then we had the 10.7. So that gets us out to, okay, we've gotten the 10.7 piece, but once we hit that 61 million, all of a sudden the cost of capital went up. And so our new isn't 10%, it's 10.5%. So that 10.2% one falls now below the weighted average cost of capital. So what this tells us is going back to this, we would want to do this project for 36 million. We would want to do this project for 29. We would want to do this project for 25. We would want to do this project, although it's getting close, for 25, and we're not going to do this $39 million project, because by the time we'd raise that money to do that additional 39 million out here, you're below the weighted average cost of capital. The weighted average cost of capital versus investors' required rate of return on debt. The return to investors is the yield to maturity, and so the cost to firms is essentially the yield to maturity is the before tax cost of debt for the investor, but it's the after tax cost of debt to the firm. And so you're going to have that spread. Essentially, the taxes here are paid by the investor. And so they have a higher required yield to maturity, but there's a lower cost of debt. And again, when we look at weighted average cost of capital with return to equity, because there's no issuance of the dividends are paid after tax for the firm, and taxes are paid by the investor. Plus, you have additional flotation costs associated with new common equity. You've got a natural, almost always higher cost of capital associated with equity than with debt. Debt's higher on the capital stack. It generally has some tax advantages to the firm. So the cost to the firm is almost always going to be higher for equity than it is going to be for debt.